Hello. Welcome to Mark Trade's Volatility for the week of July 5th, 2026. Every Sunday, we read the volatility landscape and explore areas of interest across the markets. To find areas of opportunity and to sharpen how we think about the week ahead, we concentrate on providing high volatility trade ideas to complement your investment portfolio. I look to utilize short puts, short and long call spreads, short and long put spreads, and wheels, both weekly and monthly. Disclaimer, we do not offer trade recommendations in this video nor on this channel. Nothing in this video or on this channel constitutes financial investment, trading, legal, or tax advice. Before making an investment or trading decisions, you should conduct your own due diligence and, where appropriate, consult a qualified financial advisor, accountant, or legal professional who is familiar with your individual circumstances. Geopolitical news to watch this week. The fragile US-Iranian ceasefire remains the biggest wild card. Markets entered July with a ceasefire that nobody quite trusts, though the Straits of Hormuz traffic has increased markedly and oil has fallen more than 30% since its May peak. Any fresh violation, as happened just last week, could spike energy prices again. I would like to note that there's a building falling down in New York City right now, which may make big news tomorrow or the day after. I'm not actually recording this on Sunday. Fed policy is now a bigger swing factor than usual since Kevin Walsh's first meeting as chair produced a hawkish hold with a statement stripped of forward guidance. Investors will be parsing his comments closely for rate hike signals. Trade tensions are also simmering, with Europe confronting fallout from Chinese overcapacity in the EV, wind components, solar, and semiconductors, alongside ongoing U.S. tariff deadlines and rare earths standoff that's still unresolved. Finally, keeping an eye on Latin America, where a crowded electoral calendar and a rightward political shift are pushing forward towards a more market-friendly policies, which could be a modest positive for the regional risk assets. Worth noting, markets have shown a pattern this year of reacting sharply to these headlines and then recovering once the near-term disruption looks contained. So volatility is likely, but not necessarily a lasting trend reversal. Current market regime, the Great Rotation. The Great Rotation trade has money flowing out of megacap tech and into the broader market, with small cap Russell stocks up almost 25% in the first half, their best performance since 1991, while large cap value has outperformed growth, returning 2.5% rather than about 0.9%. This bullishness sits on a thin ledge. Analysts are projecting 14 to 16% earnings per share growth in 2026. Risk premiums are low and valuations are high, suggesting some market complacency. It's a market climbing on strong breadth, but with little cushion if earnings disappoint or geopolitical shocks surprise. The volatility environment. The vol environment looks deceptively calm right now. The VIX sits around 15.5, well below its 52-week high from the Iranian war spike. That said, it's been a choppy few weeks under the surface. The index ranged as high as 23 over the last month, with an average of 18. So the calm is fresher than it looks and vulnerable to reversal given the unresolved Iranian ceasefire and upcoming Fed signals. This reads as complacent calm rather than durable calm, the kind of low vol backdrop that can snap quickly into on a single headline. Upcoming economic releases. For more details, search the FinViz economic calendar. Monday, ISM's non-manufacturing PSI came out. Tuesday, May's balance of trade reports are not likely to surprise. Wednesday, tomorrow, oil imports and stocks reports might align with the Strait of Hormuz news for a volatile move, and the FOMC minutes. Thursday, existing home sales for June and jobless claims are not likely to move the markets. Friday's a quiet day. And then I'm going to have upcoming earnings announcements for companies with over $1 billion in market cap. Monday was Bitmine Immersion Technologies, BMNR. Tuesday's PENG, Penguin Solutions. EPAC, Enerpac Tool Group. Wednesday's Levi's, Levi Strauss, and that's LEVI. PSMT, PriceSmart. AZZ is AZZ Inc. Thursday's PEP, PepsiCo. WDFC, WD-40 Company. NRIX, Nurix Therapeutics. SMPL, Simply Good Foods Company, and Friday is Delta Airlines, DAL. Next, we're going to switch into current market narratives. I'm going to skip that one and then go into interesting trades that I've picked up over the weekend and I'm looking at as the week goes on. So right now we have SION we do this in three groups. One is cheap stocks under $50. The next one is $50 to $100, and the last one is over $100. I pick 5 relatively high IV trades that might be interesting, and some possible trade ideas. So Scion Friday was at 44.64 with an IV of 180 and an IVR of 90. SION, Sionna Therapeutics, is a clinical stage biopharmaceutical company with medicines to treat cystic fibrosis by correcting a protein defect. Reasons why it might rise in the next 30 days. The top-line data from the phase 2A trial is anticipated mid-2026. A binary catalyst that could, if positive, drive a sharp move up. Analyst sentiment has skewed bullish with an average strong buy. The company highlighted positive preclinical and phase 1 data. Reasons why it might fall in the next 30 days. The same binary trial readout is a two-way risk. A disappointing or ambiguous result could trigger a sharp sell-off. At least one analyst has maintained a sell rating on the stock, reflecting skepticism some investors may share about the valuation or clinical risk. Insider trading has occurred recently. Caveats? This is a small cap, pre-revenue biotech with no approved products, so the stock is inherently volatile and heavily news-driven. Some possible trade ideas: long 90-day out-of-the-money call spread. It's a defined risk play, assuming a strong move from the phase 2 trial results. I don't know that I would go too far out on this. The move may not be that high, and it might fall back a bit. So, yeah, 30 delta, 40 delta, 30 delta, 20 delta. A weekly 30 delta wheel with elevated IV and IVR, a 30 delta wheel could provide a good theta decay even if you're assigned and need to sell covered calls, though you might get trapped in the stock. 45-day 30 delta naked put, rolling at 50% max profit, or if you don't like the time frame, just take profits at 50% max profit or at 21 days. It's high risk, high reward. Then there is MPLT. MPLT it's flat. It closed Friday at 37.09. It is IV of 264 and an IVR of 89. Maplight Therapeutics is a clinical stage biopharmaceutical company developing therapies for central nervous system disorders, with one being studied for schizophrenia and another for Alzheimer's disease psychosis. Its pipeline also includes candidates for autism spectrum disorders and Parkinson's disease motor deficiency. Reasons MPLT might rise in the next 30 days. Top-line results from a phase 2 schizophrenia trial are expected by mid-August, so anticipation could build into the month's end. Positive pre-data commentary or investor conference updates could lift the shares. Analyst sentiments is strongly bullish with a 12-month price target implying meaningful upside from recent levels. Despite a mixed phase 2 miss in June, that should be noted, shares showed resilience, suggesting underlying momentum and investor willingness to look past setbacks towards a bigger Zephyr catalyst, being their current research. Reasons why it might go down over the next month, 30 days or so. The Zephyr schizophrenia readout is a binary catalyst. A setback could be amplified given the market's concentrated focus on this specific data window. The company's other program already stumbled. The phase 2 IRIS trial in autism missed its primary endpoint for social communication, which could weigh on sentiment about the platform's broader success rate as more data approaches. Maplight now needs to meet with the FDA to determine a path forward. Added regulatory uncertainty and potential delays could pressure the stock if updates disappoint. Caveats, again, it's a small cap, pre-revenue, clinical stage biotech, so it's highly volatile and news-driven. A single trial readout can move the stock dramatically in either direction. Trade ideas, a 90-day out of the money call spread, again, fairly similar, maybe 30, maybe 20. At 90 days, I wouldn't go much further than that. It would be assuming a strong move from the pending announcements. Weekly 30 delta wheel, sort of the same as before, with elevated IV. It's got good theta decay going on, and you'd make a fair amount selling covered calls. Also, stocks in this price range tend to move dramatically. You may end up holding the stock for a long time. 45-day 30 delta naked puts, rolling or taking profits at 30%, at 50% of max profit, or at 21 DTE. High risk, high reward. MSBI. MSBI was trading Friday at 30.35. An IV of 57.6 and an IVR of 32. Overview. Midland States Bancorp, MSBI, is a community-based financial holding company, the parent of Midland States Bank, offering commercial and consumer financing, wealth management, and trust services. It's a small-cap regional bank stock. What could push it up in the next 30 days? The bank has posted a strong earnings turnaround in Q1. Continued momentum or a Q2 earnings beat could push the shares higher. Analyst price targets have been trending upward, reflecting improving sentiment. Insiders have been net buyers over the past year, and the buyout program has been extended through the end of 2026, both of which can support the share price. Reasons why it might fall in the next 30 days. The stock has already had a significant run-up, which raises the risk of profit-taking or a pullback after such a strong move. The bank has a history of financial reporting issues. Quite concerning. It previously had to restate finances and faced delayed SEC filings tied to a material restatement affecting its 2022 and 2023 results, which could resurface investor caution if any new issues emerge around the next quarterly filing. Analyst sentiment is mixed rather than uniformly bullish. The caveats. MSBI's past restatement and late filing history make it worth watching for any surprises around its next quarterly report, though its most recent filings, Q1 of 2026, were on time and strong. As a small-cap regional bank, the stock could be more sensitive to macro factors, such as rate expectations, regional bank sector sentiment, rather than actual company-specific news alone. Trade ideas. Weekly 30 delta wheel with elevated IV. A 30 delta wheel could provide good theta decay even if the assignment leads to selling covered calls. A 45-day 30 delta naked put, rolling or taking profit at 50% of max profit or at 21 DTE. And a monthly 30 delta wheel. The exact same reasonings as the other wheels. After that is YMAG. Last traded Friday at 11.55 with an IV of 28 and an IVR of 21. So YMAG is a Yield Max Magnificent 7 fund of option income ETFs. So it's a fund of funds. It is an actively managed fund of funds that provides concentrated exposure to the Magnificent 7 companies: Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and Nvidia, by investing in 7 underlying Yield Max single stock option income ETFs. It's designed to generate weekly income through a synthetic covered call option strategy rather than to track the Mag 7 stock prices directly. Not really something I'm looking to trade in unless something interesting happens. The recent pullback may lead to general positivity in the next month, but it's still feels like the Mag 7s are trying to catch a falling knife at this point. Reasons why it might rise in the next 30 days. If the underlying Mag 7 stocks rally, YMAG's NAV would likely rise too. Elevated volatility in Mag 7 names around AI news, product launches, and earnings could boost options premiums collected by the underlying covered calls ETFs, supporting distribution income and potentially price stability or upside. The fund has a track record of 12% total return over the past year, including dividends, with an average annual return since inception of 18.4%. Reflecting, so let's just put that out 1 year. So, near the bottom. The fund has a track record of, its inception of 18.4, reflecting periods where strong Mag 7 performance and high distributions combined to lift returns. Reasons why it might go down in the next 30 days. Covered call strategies cap upside. And the fund trades potential capital appreciation for income generation. So if the Mag 7 stocks rally sharply, YMAG's NAV likely won't keep pace. And if they fall, NAV falls too, without full downside protection. Structural NAV erosion is common in these option income products. Some think the strategy has limited potential to outperform peers over a full market cycle, and a broad tech AI sector pullback would directly weigh on the fund. Caveats. YMEG is fundamentally different from a typical stock. It's a high yield options-based income ETF with a history of NAV decay. Distribution yields recently around 20% are not representative of a total return, and high current income can mask capital loss over time. Trade ideas: 30 delta wheel with elevated IV and IVR. It could be a good theta decay strategy. 45-day 30 delta naked puts, closing or rolling at 50% max profit or at the 21 DTE. Monthly 30 delta wheel, the same. And I'm going to do one more in this sector. That would be WBD. So it traded Friday at 21.41. It's got an IV of 44.6 and an IVR of 45. Warner Brothers Discovery, WBD, is a global media and entertainment company whose assets include Warner Brothers Film, Warner Brothers TV Studios, HBO, HBO Max, DC Studios, CNN, and various cable networks. The company is currently being acquired by Paramount Skydance Corporation in a $110 billion deal after Paramount's offer beat out a prior agreement with Netflix. WBD shareholders approved the sale in April. As the future becomes clearer, Vol Collapse may present trade ideas. I think it was in the news again today. Reasons WBD might rise over the next 30 days. Regulatory momentum is building. The U.S. Department of Justice has already approved the deal, removing the biggest regulatory hurdles. And Paramount has formally submitted remedies to the European Union Commission, which a source says makes EU approval likely. Multiple smaller jurisdictions have already unconditionally approved the merger, adding to a string of positive regulatory news that could keep WBD trading close to the deal price as certainty increases. Investor demand for WBD-related debt has been strong, which tends to support the stock trading up towards the offer price. Reasons why it might go over the next 30 days. The EU decision has been pushed back while regulators assess Paramount's proposed concessions, and any negative signal or further delay from Brussels within this window could spook arbitrage-focused holders. The UK situation is uncertain, with August 7th deadline on whether a deeper Phase 2 review is needed, and California, New York, and other US states are reportedly preparing a lawsuit to try to block the deal. Deal arbitrage stocks, like WBD, are highly sensitive to merger completion risk. Any specific negative development could cause a sharp drop in the share price as the market reprices deal closing probabilities and timelines. Caveats: WBD is now primarily a merger arbitrage stock, with its price mostly reflects the market's view of deal closing probability and timing rather than the underlying business fundamentals. This is an unusually news-heavy, fast-moving situation with multiple regulatory bodies involved: the DOJ, EU, UK, CMA, and potentially state AG litigation, acting on different timelines, so outcomes could shift quickly. Trade ideas: a long out-of-the-money call spread, 90 days out, is defined risk play. And I would say, the call spread, well, you know what the cap of the market is. I forget what the price was. Anyways, it's capped. Weekly 30 delta wheel, again, collecting vol collapse. 45-day 30 delta naked put, collecting vol collapse, rolling or closing at 50% max profit or at 21 DTE. Interesting stocks in the 500. Interesting stocks in the $50 to $100 range. Symbols with high IV in this price range tend to be strong companies with strong news or narrative events pushing price and elevating IV. For naked short trades, be sure you are comfortable with managing the trade or taking possession of the underlying for extended periods. So CNC trade closed Friday at 67.40. That's 67.40 with IV of 58.3 and an IVR of 57. CNC, Centene Corporation, is a managed care company that provides health insurance and services through Medicare, Medicaid, and commercial, and other segments, primarily serving underinsured individuals and families in the U.S. Reasons why CNC might rise over the next 30 days. The stock has strong recent momentum. It's up nearly 14% in the past month and over 100% over the year. Fundamentals are improving. Centene delivered a strong Q1, raising its 2026 adjusted earnings per share outlook to above 340, with Medicaid margin restoration efforts succeeding as Medicaid medical benefit ratio improved and SG&A costs came down as a percentage of revenue. The company has seen positive momentum following favorable risk-adjusted results, plus Q2 earnings could act as a positive catalyst if results continue to beat expectations. Reasons why it might go lower in the next 30 days. After such a sharp run-up, the stock could be vulnerable to profit-taking. Insider selling has been notable over the past 3 months, and structural headwinds remain. The marketplace segment faces revenue headwinds in 2026 from expiring subsidies and ongoing policy and Medicaid funding uncertainty for the sector. Caveats. While upcoming Q2 earnings release is a The upcoming Q2 earnings release is a binary event within this 30-day window that could cause an outsized move in either direction given the stock's current momentum and valuation debate. Managed care stocks like CNC are sensitive to government policy changes, Medicaid rates, ACA subsidy decisions, which can shift quickly and are hard to predict. Trade ideas. Long 60-day out-of-the-money call spread. This is a defined risk play, assuming a strong move in the pending announcements. Weekly 30 delta wheel with elevated IV and an IVR. A 30-day wheel could provide, a 30 delta wheel could provide good theta decay if you are assigned and need to sell covered calls. 45-day 30 delta naked put, again, rolling or closing at 50% max profit or at 21 DTE. It's a high risk, high reward trade. Then we next want to look at PRLB. PRLB closed Friday at 76.40 with an IV of 49.6 and an IVR of 62. Protolab, PRLB, is a digital manufacturer of custom prototypes and production parts offering CNC machining, 3D printing, injection molding, and sheet metal services to engineers and supply chain teams across the US and Europe. Reasons why it might rise in the next 30 days. Protolab was recently added to both the Russell 2000 Defensive Index and the Russell 2000 Value Defense Index, which can drive incremental index fund buying and visibility. The company just posted a record quarter and earnings per share that surged 125% from a year earlier, driven by strong CNC machining demand and expanded aerospace and defense capabilities, building momentum ahead of the next print. Management is leaning into growth with new leadership, a new chief commercial officer, and the launch of ProDesk, an upgraded AI-enabled e-commerce platform meant to lift revenue per customer, and the stock is already up about 85% over this past month. So let me put that to a one-year show so you can see the one-year market, suggesting strong existing momentum that could continue. Reasons why it might go lower in the next 30 days. Q2 earnings is a binary event that could trigger a sharp pullback if results or guidance disappoint, especially after such a large run-up. The stock's valuation looks stretched after its rally. It trades at a trailing P/E of about 72, and shares are already 3.5% off their 52-week high, leaving room for a pullback if sentiment cools. Management issued cautious 2026 guidance, 6-8% revenue growth, and the biggest ongoing risk remains customer concentration in aerospace and defense, along with execution risk from its European operations. Caveats. PRLB is a small cap, high beta stock. The beta is 1.39, meaning above average volatility versus the market. So moves in either direction can be outsized. Trade ideas. Short 90-day out-of-the-money put spread is a defined risk play, assuming a strong move from pending announcements. Yeah, I guess that's an interesting play. Excuse me. Weekly 30 delta wheel, and which high IV, high IVR, selling covered calls. 45-day 30 delta naked put, same as before. Next would be SCL. It closed Friday at 56.75, has an IV of 45.8 and an IVR of 75. SCL, Step Pan Company, is a specialty and intermediate chemicals manufacturer producing surfactants, polymers, and specialty products used in cleaning, construction, agriculture, and food farmer applications. Reasons why it might rise in the next 30 days. Stepan is executing Project Catalyst, an operational efficiency plan targeting approximately $100 million in pre-tax savings over 2 years, and management noted the majority of savings are expected to ramp up starting in Q2 2026, which could start showing up positively in upcoming results. Q1 2026 earnings per share beat forecast by a penny. And with specialty products and surfactants segment showing robust growth, the market has responded favorably. Stepan has raised its dividend for 58 consecutive years, a long track record of shareholder returns that can support demand. Some research analysts have upgraded the stock to buy with a price target well above recent trading levels. Reasons why it may go lower over the next 30 days. Q1 2026 results included a net loss of $41 million adjusted EBITDA, I used to be able to say that, down 14% year over year, a $65.4 million pre-tax restructuring charge, and negative free cash flow of $14 million, showing real near-term profitability pressure that could weigh on sentiment if Q2 doesn't show clear improvement. Revenue missed expectations in Q1, raising some concerns about the top-line sales performance, and continued softness could pressure shares. The company expects further restructuring charges of $70 to $80 million in 2026 tied to Project Catalyst, which add ongoing charges and execution risk that could surprise negatively if costs run higher than planned. Watch for the upcoming earnings date announcement, and the stock is mid-transition restructuring charges cost-cutting, so near-term results may remain noisy if the long-term plan is on track. So some trade ideas, a weekly at the money wheel with elevated IV, basically the same thing. Weekly 30 delta wheel and 45-day 30 delta naked put. I think I've been over the reasoning so often enough now. Next would be Netflix, and that would be NFLX. It closed Friday at 56.75, has an IV of 46 and an IVR of 62. Netflix is a global entertainment streaming company offering TV series, films, documentaries, games, and live programming. Reasons why it might rise in the next 30 days. Netflix will report Q2 results on July 16th. A clean quarter with no acquisition rumors and no guidance misses could act as the clearing event that many investors are watching for. Valuation looks compressed relative to fundamentals. The stock trades at roughly 25 to 26 times forward estimated earnings, below its 5-year average of about 30 times. And most analysts rate it a buy with a consensus price target over $100, implying substantial upside potential. The board approved a new $25 billion share repurchase program on top of the existing $15 billion authorization. And management raised 2026 free cash flow guidance to about $12.5 billion. The ad business is scaling via a new Omnicom Axiom partnership and cheap asset acquisitions like the Radford Studio Center purchase at a steep discount of its 2021 sale price. Reasons why Netflix might go lower in the next 30 days. A Q2 earnings date is a double-edged catalyst. Netflix's model doesn't predict an earnings beat. Content amortization growth is expected to peak in Q2 before deaccelerating. And the company's last reported quarter delivered a negative earnings surprise. So another guidance miss could extend the sell-off. Netflix has shed more than 20% of its market value in 2026, and the departure of co-founder Reed Hastings has added a layer of leadership uncertainty, while Netflix's withdrawal from its large Warner Brothers Discovery acquisition and public accusations from Paramount Skydance over the media consolidation issues continue to create an M&A overhang. Stock-specific volatility has been high on mixed news. Shares dropped after management flagged a more traditional broadcaster partnership following its TF1 deal in France. A reminder that sentiment can swing sharply on strategic directional concerns, even amid otherwise resilient financials. Caveats. The July 16th earnings report is the single biggest catalyst in this window and could easily overwhelm any other factors in either direction. Views on Netflix are genuinely split. Some see a once-in-a-decade value opportunity. Others see a business facing real growth, deacceleration, and competitive execution risk. Trade ideas. A leap, 10 to 20 delta, $10 to $15 wide call spread. A flyer with 500% plus upside. I may put that on. I have not yet. Weekly 30 delta wheel with elevated IV, blah, blah, blah. 45-day 30 delta naked put. Again, the same. And then the next one up is FANGs. Microsectors FANG ETN. FNGS. Trading Friday at 73.41 with an IV of 32 and an IVR of 60. Microsectors FANG plus ETN is an exchange-traded note providing equal-weighted exposure to the 10 largest tech-enabled growth companies, currently including Meta, Apple, Amazon, Netflix, Microsoft, Alphabet, and 4 rotating names. Most recently, they have CrowdStrike, NVIDIA, Palantir, and Broadcom. Reasons why it might rise in the next 30 days. FANGs has significantly outperformed the broad market in recent years, and one analyst recently upgraded it to a tactical buy, citing potential near-term gains and a possible melt-up scenario for the Meg 7 stocks. Several of its underlying mega cap holdings, Apple, Microsoft, Amazon, Meta, Alphabet, typically report Q2 earnings in late July, which falls within this trading window. Strong results or AI-driven optimism from any of these names could lift the whole basket, given its concentrated, equal-weighted structure. Top holdings like NVIDIA and Broadcom have been key performance drivers, so continued AI semiconductor sector strength could support the ETN's price. Reasons why it might go lower in the next 30 days. The same earnings season cuts both ways. A disappointing report or weak guidance from any of the 10 concentrated holdings could weigh disproportionately on FNGS. FANG stocks are no longer outperforming the S&P and show signs of a downtrend. The daily technical buy-sell signal is currently sell, suggesting some near-term momentum concerns. The ETN's concentration in specific tech-related industries, so a sector pullback would hit FNGS rather hard, harder than a diversified fund. Caveats. FNGS is an ETN, exchange-traded note, not a stock or an ETF. It carries a 0.58 annual investor fee and represents unsecured debt of the insurer, meaning it also carries insurer risk credit, unlike a typical ETF. Its price is really an aggregate of the 10 different megacap tech stories, several of which report earnings within the next 30 days, so this period could be unusually volatile and hard to characterize with a single up or down thesis. Trade ideas, weekly at the money wheel, a 30 delta wheel of the weekly kind, and 45-day 30 delta naked put. Interesting $100+ symbols. Symbols with high IV in this range tend to be strong companies with strong news or narrative events pushing price and elevated IV. For naked short trades, be sure you are comfortable managing the trade or taking possession of the underlying for extended periods in case of an outside move. Covered calls and potential dividends may continue to offer profits while prices recover. First stock choice is FTNT, which closed Friday at $155.08 with an IV of 69 and an IVR of 100. Fortinet, FTNT, provides cybersecurity, secure networking, and secure access service edge. SASE solutions to enterprises, service providers, and governments worldwide. Reasons FTNT might rise over the next 30 days. Fortinet will report the Q2 results on the July 29th, giving investors a fresh catalyst to react to. Several major analysts have turned notably bullish recently, citing strong demand with no signs of pull forward activity, and SASE emerging as a major growth driver. The firewall market growth is forecast to be accelerating from 5 to 10%, with Fortinet holding over 20% market share. And also the company recently launched FortiSOC, a unified security operations platform powered by agentic AI. I imagine agentic AI should probably not be that central to your security operations platform in case it hallucinates, but I don't know how they've implemented it, so that's not a strong opinion. Both are supportive of growth narrative into earnings. Reasons why it might go lower in the next 30 days. The Q2 earnings report is a double-edged catalyst. Analysts remain divided on the company's growth potential, particularly its AI and SaaS initiatives. with the stock carrying a rich PE ratio of about 60. There's little room to disappoint. Sentiment isn't uniformly positive. Fortinet was removed from both the Russell 1000 Defensive Index and the Russell 1000 Growth Defense Index in late June, reflecting a shift in how the market views its risk profile amid concerns about demand and margin pressures. I just had something get disconnected. I have no idea which got disconnected. Okay. Still don't know. Sentiment isn't uniformly positive. Fortinet was removed from both the Russell 1000 Defense Index and Russell 1000 Growth Defense Index in late June, reflecting a shift in how the market views its risk profile amid concerns about demand and margin pressures. Insider selling has continued, which, while not necessarily predictive, is sometimes viewed cautiously by investors. Caveats. The July 29th earnings report is the dominant event risk in this window, given the stock's premium valuation and recent volatility in analysts' ratings from sell to price targets well above the current price. The reaction could be outsized in either direction. Analysts' opinions on FTNT are unusually split right now. Some see accelerated AI SaaS-driven growth, others see stretched valuation and demand risk. So there's genuinely contested near-top setup. Some trade ideas. Long ATM, long at the money put spreads is a defined risk play, assuming a strong negative move from the pending announcement. Monthly 30 delta wheels and 45-day 30 delta naked puts. Next is AZZ. AZZ closed Friday at 150 even with an IV of 45.9 and an IVR of 90. AZZ is the leading independent provider of hot dip galvanizing and coil coating solutions in North America, offering corrosion protection and rust coating services through its metal coatings and pre-coat metals segments. Reasons why it might rise in the next 30 days. AZZ will be, you can tell I'm Canadian, AZZ will report Q1 fiscal year 27, not going to be, excuse me. AZZ will report Q1 and fiscal year-end results after market close on July 8th, which I guess is today. It's probably already out, with a conference call on July 9th, and the company has a strong beat record. Analyst segment is solidly positive, and the average rating is buy. Fundamentals and momentum are strong. Fiscal 2026 earnings revenue grows 4.6%, with earnings up over 500%. 2027 guidance projects up to $1.78 billion in sales and $400 million in EBITDA, leveraging infrastructure and reshoring trends. The stock recently hit an all-time high of near 158. Reasons why it might go lower in the next 30 days. After such a strong run-up to all-time highs, any guidance miss or soft segment results, pre-coat metal sales were down 1.8 year over year in the most recent quarter reported, could trigger a pullback. Not all analysts are equally bullish. There's at least one neutral rating and a price target of 155, suggesting caution about the further upside from current levels after the recent rally. The company has flagged ongoing risks, including raising labor rates, raw material and energy costs, supply chain vendor delays, debt leverage on variable rate interest, and broader macroeconomic and tariff-related uncertainty, any of which could weigh on results or sentiment. Caveats. The July 8th earnings report is the key event in this window. Given the stock is trading near all-time highs, the market's reaction to this, I'm going to say it is probably going down, looking at the chart. Maybe it'll go down fast enough that you can actually buy near the bottom or use some options plays, or maybe it'll bounce back right away. AZZ is sensitive to industry construction cycle trends and commodity input costs, which can shift with broader economic conditions. Trade ideas: a weekly 30 delta naked put, closing at 50% of matched profit. This I would suggest is kind of out of the question as of today. A weekly 30 delta wheel and a 45-day 30 delta naked put. I would certainly wait to see how far this goes down after the earnings announcement. Next is DVA. DaVita closed Friday at $234 with an IV of 43 and an IVR of 66. DaVita is a leading provider of kidney dialysis and related lab services in the U.S., treating patients with chronic kidney failure and renal disease, with approximately 35% of the market share. Reasons why DVA might rise in the next 30 days. Momentum has been exceptionally strong. The stock has logged a 25% gain over the past month and 60% over the past 3 months, with, I guess, up over about 100% year to date. The analyst upgrades have been piling up, reflecting broadly improving Wall Street sentiment. DaVita was recently added to several Russell value benchmarks, including the 1000 value, mid-cap value indexes, which can drive incremental and institutional index fund buying. And the company's Q1 earnings report strongly beat expectations, leading it to rise full-year guidance, building positive momentum towards its next report. DVA might go lower in the next 30 days. Reasons include valuation looks stretched over after the huge run-up with a PE of 22 times versus its 5-year average of 14. This is a real room for a pullback or profit taking. Insider selling has been substantial, and with over 217 million dollars worth of shares in the last 3 months being sold, and multiple top executives stock sales have been reported in recent months, which can weigh on sentiment, even if not predictive. Policy risk looms in the background. There's investor attention on how much DVA could lose if ACA premium tax credits expire. Ongoing reimbursement policy uncertainty in the dialysis and broader healthcare space could pressure shares. Caveats: DVA has had an unusually strong run, so there's a lively valuation debate. And given the recent pace of analyst and index-related news, sentiment can keep shifting quickly. Trade ideas. Long 60-day ATM call or put spread is a defined risk play, assuming a strong move from pending market announcements. 30-day delta wheel, 45-day 30 delta naked put. MATX. So next up is MATX. Matson. It closed Friday at 202.57 with an IV of 40.5 and an IVR of 50. Matson, MATX, provides ocean transportation and logistics services, primarily serving Hawaii, Alaska, Guam, and other Pacific Island economies, along with expedited China to U.S. shipping routes. Reasons why MATX might rise in the next 30 days. The stock has strong recent momentum, driven in part by an increase in the quarterly dividend to 35 cents per share, announced alongside better than expected Q1 earnings. Analyst sentiment has been bullish in the $213 to $230 price range, and with overweight ratings. Management raised its full-year operating income outlook, citing strong post-Lunar New Year demand in China, offsetting weaker domestic volumes. Reasons why it might go lower in the next 30 days. Valuation looks stretched after the rally. The stock trades well above some fair value estimations, and after a 220% 5-year return, Matson no longer looks like an obviously cheap shipping stock. Any sustained pressure on shipping rates or volumes could quickly compress the multiple investors are willing to pay. Recent results have shown real softness. Q1 2026 was 1.8 rather than 2.2 a year earlier. And net income is down 56.6 million from 72.3 million. The stock remains exposed to the long-term risks of declining Trans-Pacific shipping volumes if manufacturing accelerated on reshoring and onshoring, nearshoring away from Asia, plus broader trade policy and tariff uncertainty affecting Pacific shipping routes. Caveats: MATX is a cyclical, trade volume sensitive stock, so it can be quite sensitive to shifts in U.S. Chinese trade policy, tariffs, and broader freight demand trends. Trade ideas: 45-day 30 delta call spread, rolling at 50% of max profit or 21 DTE. If you're going to be doing spreads, do make sure you understand how to manage them, or consider them put on and leave. 30 delta monthly wheel strategies and a 45-day 30 delta naked put. Next up would be UPS. UPS closed Friday at 110 with an IV of 36.9. Let's call that 37. And an IVR of 80. United Parcel Services, UPS, is a global package delivery and logistics giant operating throughout U.S. domestic and international package segments, serving customers in more than 200 countries. The company is currently mid-turnaround, deliberately shedding low-margin volume, notably reducing Amazon deliveries, to focus on higher-margin healthcare and B2B logistics. Reasons UPS might rise in the next 30 days? The Q2 earnings report lands July 28th. A beat or upbeat guidance on the second half inflection point management has been promising could act as a catalyst. Analyst sentiment remains constructive. The average analyst rating is buy with a 12-year price target of around 113. Sort of steady on as she goes kind of a price. Continued strategic investment like the recent $48 million cold chain healthcare logistics spend signals execution on margin improvement plans, which could reinsure investors. Reasons UPS might fall in the next 30 days: intensifying competition. Amazon's move to open its logistics network to outside businesses has already pressured USP and FedEx shares. Recent fundamentals have been weak. Net income and EP earnings per share both fell sharply versus the prior quarter, and the stock is down roughly 50% from its 2022 highs. Leadership governance uncertainty, including a board member's resignation following an external CFO appointment, plus lingering scrutiny from the NTSB investigation into last November's UPS jet accident. Caveats. Earnings on July 28th is likely to be the single biggest event driver. This adds binary event-driven risk and is hard to predict either direction. UPS carries a large dividend yield, 6 to 7% range, which some see as a value support, but others read as a market signal of concern about sustainability. Trade ideas: 45-day 30 delta call spread, and taking that at 50% max profit or 21 DTE. An iron condor might make sense too, as I'd kind of bet that it's not going to move that much. 30 delta wheel, 45-day 30 delta naked put. And summary of the week to come: keep some powder dry. The markets might have some pockets of excitement in the near future. It would be a shame to be fully invested in a quiet market and sitting on the sidelines when opportunities arise. Welcome to the back half of 2026, and good luck at trading the week ahead.